Good afternoon, everyone. Thank you very much for being here. My name is Michael Mastrandrea, and I am the Research Director of the Climate and Energy Policy Program, which is part of Stanford's Woods Institute for the Environment. The Woods Institute is a founding pillar of the Stanford Doerr School of Sustainability, bringing together scholars from across Stanford to advance understanding and develop practical, just solutions to pressing environmental problems. The Climate and Energy Policy Program combines interdisciplinary research with direct policy engagement. It serves as a practical, timely, and neutral voice informing decision-making on wildfire, electricity, and insurance policy. As the risk of catastrophic wildfires has emerged over the past decade, many California homeowners are facing rapidly rising insurance premiums and evolving coverage options, including rapid growth of the state-mandated FAIR plan that has become the only coverage option for many customers. Today, we will present new research led by Nam Nguyen, a research fellow at the Climate and Energy Policy Program, on recent trends in insurance availability and affordability. This will be followed by a panel discussion with insurance experts on policy responses, moderated by Michael Wara, director of the program. There will be an opportunity for questions from the audience during the panel, so please submit your questions using the Zoom Q&A feature, and we will get to as many of them as possible. And now it's my pleasure to hand it over to Nam to present our work.
Good afternoon, everyone. I'm Nam Nguyen again. Thank you for joining this webinar. To set the stage, California is currently in the middle of a massive insurance market shift. As our state faces escalating wildfire losses, the traditional homeowners insurance market is becoming increasingly inaccessible. We have twin challenges here. The first, a deepening affordability challenge as rising premiums create severe financial strain. And second, an availability crisis as admitted insurers scale back underwriting, leaving homeowners with fewer options. Today, we are discussing the empirical findings of our latest white paper. Our goal is to explain what has happened in the market and what is evolving this year using data current through March 2026. Specifically, we document rising premiums, escalating out-of-pocket costs, and the expanding footprint of the FAIR plan. Our data suggests that at this moment, the insurance crisis isn't necessarily getting worse, but it is not showing signs of improving either. We will conclude today by discussing what homeowners and policymakers can expect in the near future and the steps required to break the trend that we're in. The changing market is disrupting homeownership in California. For most people, insurance is a prerequisite to buying a home, as lenders generally require adequate coverage before issuing a mortgage, and maintaining that coverage is a requirement for servicing the mortgage. When premiums spike, monthly mortgage payments can suddenly become unaffordable, and this is a direct threat to the financial stability of many Californians. In addition, without that coverage, homeowners are far less likely to recover or rebuild if their home is destroyed. To evaluate this disruption, we utilize mortgage escrow data provided by Intercontinental Exchange spanning between 2013 and March 2026. Rather than viewing this as an all-encompassing ledger of the entire market, we treat these transactional records as a highly responsive proxy. This approach gives us a stable baseline for understanding the market's broader trajectory and the context for how premiums, deductibles, and the FAIR plan footprint move together. In our first figure here, we track the average monthly insurance premium for California against the rest of the US. The upper orange line tracks the US average, while the lower blue line tracks California. And as you can see, there are steady increases across the country. Between 2020 and 2026, California premiums surged by 84%. On average, Californians pay about 85 cents on the dollar compared to the rest of the US. Now, you might wonder why California's baseline has historically been lower than the rest of the country. We believe that this is an artifact of our unique regulatory environment, since insurance, and especially its pricing, is regulated by the state. While premiums are generally increasing across the board, a homeowner's experience can vary depending on where they live. To illustrate this point, we group zip codes into 5 categories of fire risk scores, or FRS, from the California Department of Insurance, with FRS 1 being the lowest risk and FRS 5 being the highest. We can see that the average premium increases vary in the state. Homes in the high risk zones, such as FRS 5, are seeing their insurance bills increase at the fastest rate. In the data, the majority of these homes are in the low risk areas, which is the 65% on our table, and only a smaller share of homes are in the most risky areas, such as FRS 4 and FRS 5, which are 14% and 0.5% respectively. It's important to keep this in mind because broad regulatory interventions aimed at solving the crisis in high risk zones run the risk of destabilizing the insurance market in other regions. Insurance premiums alone don't tell the full story of the changing market, so we have also documented the change in deductibles. As a reminder, a deductible is the amount a policyholder must pay out of pocket before their insurance plan begins to cover claims. The solid red line represents the admitted lines, and the dashed blue line is the fair plan. While admitted deductibles are increasing, fair plan deductibles have skyrocketed, pushing towards $6,000 by March 2026. These deductibles are rising for two main reasons. First, insurers are managing their financial exposure by raising the threshold for a payout. And second, homeowners are likely choosing higher deductibles to lower their premiums. In either case, more of the financial risk transfers back to the homeowner. While this is happening, many homeowners are losing their admitted policies or getting non-renewed and having to shift into the fair plan, meaning they are taking on high deductibles for a bare bones policy that only covers the physical structure. To protect themselves, many of these homeowners have to supplement their fair coverage. Here we're comparing average annual premiums paid across three distinct categories of policyholders. First, we have residents on the admitted lines, which is the solid red line. Then there are residents on the fair plan alone, our dashed blue line. And then we have residents on the fair plan combined with an additional policy, which is our dotted green line. We created this third category because it is very common for fair customers to hold a second policy. Since fair provides limited coverage, our data showed that at least 40% of fair policyholders supplement their coverage with an additional policy, such as a difference in conditions. Buying an additional policy can drive costs further. Fair policyholders who supplement their coverage end up paying an average $2,000 more than those relying on fair plan alone. As more people enroll in the fair plan, admitted carriers have to find ways to support a growing fair plan, knowing that they are ultimately on the hook if the fair plan runs out of money to pay claims. To see how the carrier risk management translates into home buying, we look at the mortgage origination data. This plot shows the percentage of new mortgages that are created with fair plan insurance, revealing a distinct upward trend in some of the previous years. Tracking mortgage origination here gives us a sense of voluntary insurance availability for people actively buying a home. Now, the data does show that the fair plan share of originations has cooled off from its recent Q1 2025 peak of 8.1%, and then landing at 5.6% in Q1 2026. However, its influence on total policy market share is expected to persist. Between December 2020 and March 2026, fair market share for single-family homes grew from 2% to 5%. If there is a silver lining in this chart, is that the deterioration in availability we saw over the last few years seem to slow down. While conditions are not worsening, they are not getting better either. As the market is in a sort of holding pattern, the state has been stepping in to incentivize more insurers to underwrite more policies and reduce dependency on the fair plan. The California Department of Insurance primary initiative to bring relief is the sustainable insurance strategy. To directly address the availability crisis, a core component of this strategy allows insurers to incorporate catastrophe modeling and reinsurance costs into their rate making for home insurance. The goal is to make premiums more actuarially sound and restoring admitted market capacity. However, its ultimate effectiveness in improving conditions for homeowners remain uncertain for two key reasons. First, actual implementation is highly uncertain because the CDI retains substantial discretion over how strictly or leniently it applies these new rules. That is to say, we're not sure if insurers would be able to adjust premiums enough to protect against losses. The second reason is that transitioning to these new rates means premiums are expected to increase in many parts of the state, holding all else constant. As a result, many homeowners may encounter higher premiums they cannot afford. To summarize what our white paper demonstrates, the market is undergoing a fundamental shift. Solving the insurance shortage requires setting actuarially fair rates, but ensuring Californians can afford those rates requires us to fundamentally change our physical risk. When it comes to housing and communities, long-term financial relief will require the widespread implementation of home hardening and defensible space to protect neighborhoods from urban wildfires. Lastly, must prioritize building new homes in safe areas over high-risk regions. When you strip away all the regulatory and financial complexity, the best way forward is to burn fewer properties. Thank you. Hand it over to Michael.
Thanks, Nam. Really exciting to see this work coming out, and thank you for all the work on the project and to the rest of the team, the co-authors on the project. We're now going to have a discussion of the kind of evolving trends in the insurance market with three experts that come from different perspectives. Um, Emily Rogan is a senior program officer at United Policyholders, where she, among other responsibilities, I get the sense there are many, leads research efforts at UP. Penny Liao, an economist and fellow at Resources for the Future, who has conducted research on insurance markets generally, both at RFF and before when she was at the Wharton Risk Center, and in particular on the California market. And Heather Kanzelmar, who is principal actuary or principal and consulting actuary, sorry, at Milliman and leads Milliman's work on wildfire. And so it's really incredible to have the three of you to discuss the situation in California and more broadly in the Western states that face significant wildfire risk. Um, Emily, I'm going to lead off with you and just ask you a sort of opening question and give you an opportunity to introduce your perspective. What are you hoping to see in this evolving situation that NAM has sort of charted out for us in the coming year to 2 years? What makes you hopeful? What would you like not to see happen as well?
Thank you so much for having me. So again, I'm Emily Rogan. I'm the Senior Program Officer for United Policyholders. And for those of you who are not familiar with our organization, our work has three programs that feed into each other. So our advocacy work, where we're tackling these problems around availability and affordability and monitoring what's going on, is informed by our work in our recovery program that helps people use their insurance after disasters, and also our preparedness program, where we help people figure out how they can be savvy insurance consumers. For decades, we have been asking people to take a look at their insurance policy, know what's in it, and now more and more we're seeing that the new normal is that people are paying more attention. And because of these really steep rises in how much it's costing them, and it's having more of an impact on their pocketbook. What we want to see, well, what we don't want to see is wildfire being carved out of policies. You know, we are in this work day in and day out, but even just seeing the increasing annual home insurance cost slide, when you really see it laid out there, it's becoming more expensive. But you see that note where people have to have two policies just to cover their wildfire. And what wasn't included on that slide is if you have to add a flood policy or if you have to add an earthquake policy, which California has. So we don't want to see wildfire carved out because we're worried that people, when it's optional, people will pass. But we do want to see is what was mentioned about home hardening and reducing risk, and we see that as the way for both insurers to come back to the marketplace to help build back a better insurance marketplace and have that connection with affordability to get those costs down. So thank you so much.
Thanks, Emily. And I should have said at the beginning, and I neglected to, that the Q&A should be open, and we'll be taking audience questions later in the discussion. Penny, you've done research on the California market and more broadly on insurance markets nationally as they confront challenges, changing risk environment due to climate change. What's your perception of where things are heading in California and what you're hopeful about and where you still see continuing challenges.
Sure. Yeah. So I am an environmental economist. So my view on the issue is a little broader and mainly from a research perspective. What we're seeing in California, the same kind of dynamics we have seen in other kinds of perils as well. For example, in floods, we have a national flood insurance program because insurers were not willing to provide flood coverage. And we're seeing a growing FAIR plan, which I think is quite alarming. What we don't want to see is the FAIR plan keeps growing and becoming a larger part of how people cover their flood damage in California. What makes me and also just to add on to Emily's point about wildfires being peeled off as a single peril coverage, um, in the flood space we see that when flood insurance is not mandated, people then start to choose to forego it. And I have also looked at international cases in countries where they have a single peril that is not bundled into a homeowner's insurance or standard insurance that homeowners get. Um, they tend to have low take-up rate for those perils. So uh, the picture is very clear that on the primary market, you really don't want this to be separated. Um, what makes me hopeful is that I have been watching sustainable insurance strategy very closely, and yes, like it's still early days and hard to tell whether it's making an impact. But it is somewhat encouraging to see that insurance companies starting to sign on to the strategy, and are trying to provide more coverage. There are a lot of discussions about how to modify some of the provisions to make them more effective. And I think that continual discussions on these issues will be very helpful.
Heather,
Yeah.
as you work with companies and provide kind of insight and analysis in insurance rate making, how do you see the situation evolving? What are you hopeful for in the next year to 2 years, and what are you worried about?
Yeah, so I'd say, the way that kind of the market has shifted and as Nam mentioned, you had, after the 2017, 2018 fire seasons, the main issue was that availability of insurers pulling back, non-renewals rising, the FAIR plan growing, which I think has been mentioned by Penny and by Emily of, at its core, I think availability is often a pricing problem. Of if insurers don't believe that they can charge rates that adequately reflect the risk that they're taking on, then a rational business response can be to stop writing that risk, which isn't what we want to see. I mean, you could tell from the charts as well, right? The admitted coverage where available was more affordable and is also more comprehensive. So reforming the regulatory framework can help address the pricing constraint directly. But it is also true that moving towards actuarially sound rates can increase costs, especially for higher risk homes, which can put pressure on affordability. And those, to me, are two kind of fundamentally different problems that require different solutions, even though they are interrelated. So while the availability side is primarily kind of that market structure or pricing question, affordability is more of a household cost burden question. And so when regulatory intervention like CIS and like other interventions in that insurance market can address the availability issue, it doesn't change the underlying physical risk of a home. And so from my perspective, what gives me kind of hope is that durable path to affordability, which is reducing that physical risk. Because if the expected losses come down, the actuarially sound premiums come down with them, which I think is really critical. And so that kind of brings me to the one of the things I'd like to see, which is more investing in mitigations like defensible space, home hardening, community level risk reduction, as well as tools that make those actions that communities are doing more visible to insurers, because it has to be visible for insurers operationally to be able to ingest that and to be able to build it into their pricing and underwriting workflows. And thirdly, also very important is, when we think about the affordability pressures, having that targeted assistance to those most in need. So those households under the greatest strain, in those high risk areas that may need means tested assistance or mitigation grants or other types of support to kind of get to that more sustainable market and premium level.
So that last point that, or your point, Heather, that the true long-term path out of this is by reducing risk, like that premiums have to equal claims plus expenses at some over some time interval. Is I think where a lot of the questions we're getting from the audience are actually coming from as well. It's like, how do we um, I'm seeing questions that I'm going to ask the three of you about because I think goes right to our conversation. How do we actually get that positive cycle going where we are seeing substantial investments in risk reduction, which to be fair, California has invested a lot in utility mitigation since 2017, not nearly as much at the community and homeowner level. But how do we get that community and homeowner level kind of incentive working right, where um, uh, people know what to do, they do those things, they make them visible to insurers, and then they can be recognized for having done those things. What are the pieces that are missing right now in that virtuous cycle that we should be thinking about how to fix?
I I can take a first stab at this, perhaps. Uh, so it's a very complicated question. Because there are so many different kinds of mitigation actions that can be taken by different stakeholders. There's household level, there's community level, and then there's field treatment project outside of the community that affects the overall landscape. Um, right now, I think that the level of actions that are taken is not at the scale that we want to see. And so the question is, do we need to rely on market incentive, for example, like an insurance premium discount to motivate them? Do we need to have some kind of mandate, like a building code that dictates how do we build homes? Do we need to have some kind of zoning restrictions of, where do we build? I think all of those questions are good entry points into this question, are good entry points into the overall strategy. In terms of Heather's point about, the actions need to be visible to insurers, I very much agree with that. We've looked at premium discounts that insurers are giving in California in a recent paper. So starting from because of a reform in 2022, insurers are mandated to give discounts to 12 different options, including defensible space, um, maintaining defensible space, including home mitigation, structure mitigation. And we've looked at those level of discounts, and they're really low, especially when compared to the cost of action. And part of the reason, um, as we analyze it, is because perhaps we don't have a full picture of like what each individual actions are actually doing in terms of mitigating the risk. Do they work together? Do they individually Are they individually effective? And how much risk do they actually reduce? The other piece of the puzzle, I think, is also that even though you know what this household has done um, to mitigate risk, you don't necessarily observe the neighbors. And as recent years, we've seen the urban conflagration as becoming a bigger issue where fire often spread through the neighbors, through embers, going from your neighbors to your house. So how much your neighbor has mitigated really also affect your risk, and insurers don't necessarily see the next house or the neighborhood's overall environment. And so I think that having more systematic collection of data and sharing of those data could be really important here.
Emily, would you like to add anything?
I would. Thank you. I think there are a couple points here that are really important. There is a lot of really great work going on up and down the state, where local fire safe councils or regional fire safe councils are trying to implement and trying to make people care about these issues, right? And take those actions. And so some of these items are pilot programs where we have a working group that tries to connect the good work that people are doing in one part of the state to inspire others to create programs in their areas. But the funding is, I think, where it kind of culminates, where the counties that are making the most progress have funding to put these grant programs in place to help people. Because just like climate change wasn't caused by just one person, it also won't, the wildfire risk, we have more wildfires that are happening, but the risk that you need to reduce lands on an individual homeowner's back, where they have to invest their own money to strengthen it, and that's a good thing, right? But it's a combination. You don't want to just see somebody making those investments in their home because of a wildfire, or just because of the insurance part of it. It's a combination of everything. Of this is the world that we live in. We want to make sure that our homes can be stronger and withstand whatever comes our way. And that's not foolproof, right? There are, we talk to plenty of people who are just jaded, and they don't think that the wall of flame, they won't do anything because wall of flames. And also there is just the human aspect of it. If you accidentally leave your window open when you're evacuating because you're rushing to get your dog in the car, there are just, human elements to it. So we're not saying that these efforts are going to give you the strongest home, that it will not burn down. We can never commit to that. But I think as a community, we can't, a community that you live in, but also the community of nonprofits and academics and insurers and legislators and everybody who is in working on these issues, we can't agree that we have to try. We have to try something. Let's get it moving. And I think these fire safe councils, and when we're putting money, when we're investing back in to help homeowners take these steps, we're investing in solving this problem. And I just want to give another example of why it's so hard to solve, and we're going to go a little bit, I think, towards Los Angeles. But if you're rebuilding after a wildfire, your insurance doesn't help you rebuild up to the standards that complete everything to get that wildfire discount, right? They'll get you up to code, but there is still room between code and where the top level of the discounts that you can get from your insurance. And so I think there's more conversation and just practical work to be done in order to take a more holistic and more whole community approach to this.
Thanks.
And
Oh,
Michael, I'd love to chime in and too if
please do.
yeah, so I think both Penny and Emily have said some great things here in terms of when I think of it on the actuarial side or from a rate making perspective of I don't think we can view the mitigation kind of equation as this transaction of, where individuals can do specific actions and they will always get a credit, and it will always be a significant credit for each individual kind of mitigation action, because it's a complex interdependent peril from a risk perspective of what you do to mitigate your home affects your neighbor and vice versa. And there are all of these complex considerations that, take some evolution in the science, evolution in the modeling, evolution in the data infrastructure to collect that information. But I would also, the way I think of it as well is you don't wear a seatbelt just to get a discount on your auto insurance premium, right? There is this element to it where it's not entirely on the insurance sector or on the utility sector or on any individual sector to provide the full incentive for loss mitigation. It is really important that the homeowners, that property owners, renters, folks are taking kind of responsibility for their own risk and putting it in their own hands, where they don't want, their property to burn down. They don't want lives lost. And there are things that they can do about that, from even, the individual, but even especially so at that neighborhood collective action level. So we kind of have to overcome this stack of frictions of what do I do next, and how do I get a contractor, and what should I do? And I think there it is a lot of positive bright spots when it comes to science-based standards. You have the Insurance Institute for Business and Home Safety, their wildfire prepared home standard, their neighborhood standard. It will take time, I think, for these actions to kind of get momentum at scale. But I do think that they will be very positive. When you view it as that holistic system, you're much more likely, because of the nature of the risk, right, to be able to recognize that from an insurance operations standpoint of both pricing and underwriting, because you see that not just a single action has been done, but kind of that whole stack of actions that makes a meaningful risk reduction.
Yeah, and so this actually leads into a question I want to ask the group. And should we be thinking about this? I mean, we have to think about this problem at multiple spatial scales. But where in your work and as you think about helping communities to be safer, I really want to emphasize something that has been sort of percolating through all this. And Heather, I thought you put it really well about wearing a seatbelt in a car. I wear a seatbelt not to lower my insurance, but to make sure that I'm alive so I can raise my children and be a good parent. Like that would be like how I'd articulate it first, right? And and I know, and I think many of us on this call and or in this webinar and probably listening to the webinar also know or have been directly impacted themselves by catastrophic fire in California over the last decade. So many of us have, and if you haven't personally, probably you are friends with people that have. And the trauma from these fires is real and lasting for people and for communities. But I want to ask, how much should we be thinking about this problem as a homeowner problem, as a community problem, or as kind of a regional problem, right? And you could imagine focusing on different types of mitigations, um, depending on how you think about the problem, right? Some people will say house out is the right way to think about mitigating risk for wildfire. Other people will say no, you got to think about it at the community scale. That because of the spillovers between homes, maybe we need to, even for the homeowner home hardening approaches, really focus on hardening kind of herds of homes or groups of homes as a cluster. Um, and then there's also been a lot of focus in California on landscape resilience and um, putting fire and fuel treatments back into forests that have been deprived of fire since the extirpation of Native Americans in 1850 and later, and then the fire suppression efforts of the 20th century. So, what's the right way to think about this problem, and what's the right way to think about it as it connects to insurance?
I have something to add to that. I think there's another level there, which we deal with quite a bit, which is on the familial level, where it's okay, if something were to happen, what would we do? Would we stay here? Would we want to move closer to grandparents or closer to grandchildren into an area? Would we want to rebuild in an area that could potentially have another wildfire? And would we want to stay, right? Or would we want to rebuild? And I think that that's another level that in the here and now, as we, are discussing these higher level problems of how we're going to solve the marketplace and how we can communally or regionally reduce risk. Every day homeowners are having to, maybe they're not even thinking about it, but we ask that they think about it, because a lot of what we see is that you pay your insurance and you're expecting that it'll be there when you have this loss. And as rates are rising and as perhaps coverage is being carved out as well, it's still the number one source that will get people back home after a disaster. So we're making good progress on even having this conversation and having the research and having the standards on what we can do. But on an individual level, like it's June, there could be a wildfire somewhere in California that's devastating, over the summer or over the fall, or now we know over the winter as well. So having these conversations that it still it still has to work. It still has to work there. And having people talk about it of what, do I am I able to get a loan? What do I have enough to rebuild, to replace my home? I think those are important conversations to have as well, um, because more and more the financial burden after a loss is also being put more on the homeowner as well.
Yeah, I'll just note that, a project that NAM is currently working on involves trying to develop detailed estimates of underinsurance in California and understand that problem through time as well. And of course, it's going to interact. We saw in the data that NAM showed the rising deductibles. But another logical response of a person that's trying to afford living in California, which is hard enough without these challenges, would be to reduce coverage, in particular coverage A. But that means after a fire, they're in a really difficult position. And we're interested in understanding that problem better. Does anyone else have thoughts about, sort of community scale versus homeowner, or if homeowners have to act, but we have to achieve outcomes at community scale, how do we bridge?
Yeah. Uh, oh, Heather, you can
Oh,
go
go ahead,
first.
Penny.
Oh, yeah, I was just gonna say that I worry about the framing of this a little bit about whether this is a homeowner's problem or a community's problem, because it really, at the end of the day, it's not about that. It's about how do they coordinate to solve the problem. Um, and in my mind, the community is a really big part of this, precisely because of that collective action problem where your risk depends on your neighbor. So if actions can be implemented at the community level, there is a level of assurance that we're doing this together. For insurers, it's also an assurance that this community is doing something and enforcing their actions. And It also really depends on who the decision maker is, because there are some good examples of some communities are already, their fire chief are taking proactive actions through inspections to educate people and to work with homeowners in their jurisdictions. Marin County really come to mind. I know that the other two panelists have really good examples. But it's also important to recognize that it depends on the community's capacity. Some communities do not have the same level of capacity to do things. And so it becomes a regional problem. And, at the state level, policymakers should be thinking a little bit more about perhaps how do we help some of the communities that are lacking capacity um, to take action.
Yeah, Penny, I love how you frame that in terms of like it's not a one or the other of at least as I think about it, it's kind of the all of the above of we have to think about it from a homeowner standpoint. We have to think about it from a community standpoint. And and from a forest management or regional problem, we also have to tackle that as well. And utility kind of grid hardening, which as Michael pointed out, there's been a lot of good work that's been done in California on those types of mitigations, but they all kind of interact of, in some of the research we've done, community fuel reductions have the greatest impact for the homes that haven't mitigated, right? Because now they're protected somewhat by the community and the actions that it's taken. We see things like shadow effects of if a specific property is, well mitigated, there can be kind of a shadow that protects other properties, or if it's very defensible from a fire suppression standpoint. Urban fuel breaks like parks and roads and where they're placed and what that configuration looks like can really affect the risk. So I think we have to think about it at each of these different levels where, we have the homeowners taking the individual action because to get that collective action, the neighborhood action at scale, you have to kind of reach that social tipping point where people see other people doing it. It becomes more normalized. Sometimes, it can be difficult when you say, well, do I really have to move this landscaping or do I really have to change the aesthetic of how this looks? And so seeing other people take action is important. But then you also want to be strategic at the community level and at the landscape level as well. Because that's where you're really going to see the biggest reductions in expected loss is once you have all of those forces kind of coming together. Because otherwise, from a wildfire standpoint, it's going to exploit whatever the weakest link is, whether it's an individual home or whether it's the lack of a fuel break or dense structures. it can be really difficult to be protected without kind of those different scale levels of mitigation action.
We haven't talked about utilities so far in this conversation, but if you do the math on structure loss, and at least in California over the last decade or so, utilities are, they may not cause most fires. I think Heather, in a panel we were on recently, you suggested about 5% of ignitions are associated with utilities, but they cause a lot of the most destructive fires. And if you start adding up the structures lost by cause, utilities really stand out as a problem. What role do utilities and the PUC have to play in solving for this problem? And are they doing the right things? Are they doing too little, too much, not the right thing in your view?
Yeah, I would say, I think it's interesting because it is this cross-sector nature of the challenge where utilities are doing a lot of things. The PUCs are, seeing the wildfire mitigation plans, seeing, the specific sensitivity, because there are trade-offs in all of this when it comes to especially utilities of if they cut the electric service during high, winds and extreme conditions, then there are economic impacts to that as well and financial impacts to that as well. So it is this active thing that they're trying to manage from a situational awareness, from a grid hardening perspective. And I think there's been a lot of really positive developments there. I think the challenge is then connecting it to the risk modeling of, on the insurance side or on other sides, like how do you recognize that those actions have been taken? How do you quantify the impact that that has? And I think that's still an area where there's a lot of work being done of what does that really mean from a risk reduction standpoint? Even though we know just, from empirically and observationally, right, if you take those actions, it reduces the risk, but then you have to put numbers behind it in order to reflect that in insurance premiums and in other kind of financial markets. So I think that's going to be really important in terms of how we frame the problem and how we recognize it, but I don't think we're there yet.
Would any of you, we have actually a question about some of the comments that were made earlier by Emily and Penny about kind of carving out wildfire from the standard HO3 policy. And both of you worried about take-up rates. An anonymous attendee asks if that policy were mandatory in some way, would your views change? Or if it could be made mandatory in some way, would your views change? Or do you question whether that's even possible? I guess sort of exploring that concern a little bit more deeply.
That would not change my view on it. I think that there's an important piece to, when we're talking about affordability, you know, just to hammer home that we're not talking about a discounted, a cheap policy, right? We're talking about whether or not somebody can, pull together as much to make it, feasible for them to still live in their home. And so it's not about getting a good deal. It's about being able to protect your largest asset, your home, right? So I just want to put that perspective on it. And so, I don't think, I don't think an optional coverage is the right way because, in San Francisco, you can look at earthquake coverage and in high, and it doesn't necessarily have to be that you're on a fault to have that high risk, right? You don't have to be in necessarily the worst floodplain to have your home flooded. And especially with climate change, we're seeing more and more that that the risk is going up in many different types of disasters. But you still have one home to protect, right? You want to make sure that, your piece of property is protected and that you have a place to live. We also see a lot of carve outs when you have to add on a policy, which I mean, for instance, flood policies don't cover your loss of use. So you don't have the coverage to have be able to afford temporary rent somewhere while you're still paying your mortgage and repairing your property. Or they'll have caps on how much you can insure your home for in different fair plan policies. So we see them as they're, out of the box. They are the additional pieces that are created don't look like a normal policy, and that hurts the homeowner because they just it becomes a less quality of a product, right? So you want to make sure that you have ideally one thing that will cover your home. Think about how much the average person knows about their insurance. And I would encourage everybody who's attending this webinar or hears it later to then find where is your insurance policy? Dust it off. Have you read we have a new disclosure where your insurance company will tell you what actions you can take for a wildfire discount in California and how much of a discount that will reduce your coverage. Did you know that, right? What is covered? How much would you have to rebuild per square foot? These are questions that might sound like homework now, but if you have a loss, it's something that you're really going to have to learn about, and you have to do it in the most traumatic situation ever. So I would encourage everyone to look at it and see if they're surprised about what is covered and what isn't covered in their policy.
Just to add a little bit to that, when we talked about mandating insurance, we need to think about what is the mandating mechanism. And usually the mandating mechanism is through mortgage. The mortgage lender usually requires homeowners insurance in the in the high flood zones. People are required to have flood insurance, but in the flood space, what we see is that right outside of those areas, people have a very low take-up rate. And any kind of perils you can think about it, it necessitates, delineating some kind of zones, and then we worry about when it's not delineated, then what happens. The other, we also have a paper that we looked at kind of like premium change, premium increase is going to exacerbate the problem. So even in areas where flood insurance is mandated, when premiums started increasing because of a reform, we see that people start dropping their insurance, and that is because many people actually do not have an active mortgage anymore, and so they may just drop that standalone coverage. And so this kind of dynamics is something that I worry about for wildfire.
Mhm. There's some questions about from the audience about what effective wildfire mitigation at the community level can look like. And I want to subdivide that because I think there's an easy answer, which is, build new communities, IBHS, wildfire certified communities. Um, but the reality in places like, I mean, this is partly why, not the only reason, but a big part of why housing is so unaffordable in places like California is we don't build very many new houses. There aren't a lot of new and particularly new master plan communities. And so I'm curious if any of you could point to examples of successful mitigation that led to positive insurance market outcomes for people.
Oh, I can take a stab here. So, one place to look to is Paradise, right? But again, that's a little bit of an anomaly because they had to have a wildfire go through, right? They had fewer people built back than had lost their homes. And then they really had to fight to get on the map to say, look at all the work we've done for our community to become to in the wildfire mitigation space and to physically bring in, insurance company executives into their community and tour them around, right? That isn't necessarily feasible for every community, and it isn't necessarily the gold standard because you don't want a community to have to burn in order for it to be built back up to standard, right? Um, we want the opposite. We want homeowners, communities who are are worried about their risk and taking positive actions there. So there's a little bit of a disconnect there. But one of the things that they had was the mindset, right? That it was important to everybody in that community. And it was important to be to engage insurers to come in and to see the work and to show them examples. And I think that's where we're moving. We're seeing that happen as well in Ventura as well. They've had quite a long history of wildfires. And it'll be interesting to see what comes out of LA once both the Palisades and Altadena are rebuilt.
Penny, Heather, any other thoughts?
I mentioned Marin County before. I mean,
Mm.
one of the biggest issues, I think, is the existing housing stock that is unmitigated. We know that building codes work. Properties that are built under fire resilient codes, when a fire passes through, they suffer much less damage. It's an effect that you can see from an engineering perspective as well as from an empirical perspective, just by studying existing fires. And in Marin County, through their inspection program, I know that they're doing a lot of work trying to educate homeowners in terms of what kind of actions they can take in terms of clearing their defensible space, which is a relatively lower cost action, and then all the way to how do you improve structures. I've talked to companies that build these software platforms for these inspections, recording, the characteristics of the property and the defensible space status. And they are more focused on trying to provide actionable items for homeowners and trying to lower the cost of taking action, not just the financial cost, but also just like the hassle costs and there are also, I know that some people are running experiments trying to see what prompts people to take action. Things like sending homeowners nudges about what their neighbors are doing and trying to use some kind of peer effect. And there's like different levels of success that is being observed, and more and more actions are being studied. Um, and in Marin County, I heard that what is happening is that some insurers are coming back and getting more interested in learning, what homeowners are doing in that community and what community level actions are happening, and which will potentially lead to improved insurance availability and affordability.
I,
we have a
I would
number of, oh, sorry, after you, Emily.
I would also add that they Fire Safe Marin in Marin County has done a phenomenal job of providing visual pieces, whether it's YouTube tutorials on how to do the work, or they have a wonderful landscaping guide of what it would look like if you were able to have the defensible space and the landscaping that would meet the standards of zone 0, and you get into all the fancy language, but they're able to show it of what it could look like. And that's a really important thing as we're in this in between this growing phase of, the whole state is not yet on board, that we're going to have to move in that direction. But being a leader in showing us what it is and how you'll be able to do it, and coming to your home and doing the home assessment. I think we're getting over the barriers that there will be someone doing a home assessment. But what are those next steps? They're doing a wonderful job leading there.
I just know we have a couple of folks from MWPA on the Zoom with us in the audience, and one of them just noted that unfortunately, Marin does use Fireside. This is just a sort of pretty fancy defensible space inspection program. I was inspected by Fireside by Marin County Fire. Unfortunately, the person says under 50% of inspection reports are opened at this point. So there is a behavioral component to this that's very real that we need to work on it. And I'd say a number of the comments also reflect this kind of human behavior aspect of the problem. And that it's hard for people to understand and respond to catastrophic risk given all of the other pressures in their lives. We had a question about something that's not really covered in the paper in much detail, but I'm curious for all of your perspectives on, and that is the role of surplus lines in the insurance market. And so for folks who don't know what that means, there are really three kinds of homeowners insurance policies in the state: admitted lines, which are the sort of more regulated insurers that are admitted to sell policy in the California market; the FAIR Plan, which is a state mandated insurer of last resort that's run by all of the insurance companies in California. And then surplus lines companies, which are out-of-state insurers that sell policies in California and are more lightly regulated, in particular in terms of the prices they charge and the terms of their insurance. So they're able to offer products, arguably offer products in kind of harder to insure contexts. Um, Curious how the three of you feel about surplus lines playing I mean, it is playing a larger role in California, particularly for homes above the $3 million cap for the FAIR Plan. But even at values below that $3 million cap, more people are going to surplus lines. And what do you think about that dynamic? Is it a good thing? Should we encourage more of it? If we do see more of it, are there steps we should take to make sure that surplus lines policies meet kind of minimum standards? Curious for any thoughts on the role of surplus lines.
Yeah, I'd say at least from thinking kind of from the insurance market perspective, they do have an important role kind of as that pressure valve as well of, when if the admitted market isn't able to cover specific, really specialized risks or high value homes or other types of unique risks, right? The surplus lines market potentially can and can offer that through the greater flexibility of their forms and rates and rules compared to an admitted traditional insurer. As you mentioned, like the caps on the FAIR Plan kind of issue of if you have a higher value home, that may be your best option, right, to get more complete coverage if an admitted insurer either doesn't have something available or it's not affordable. But I do think, it's also important for folks to understand kind of the differences between if it's a surplus lines or an admitted policy, those come with different protections of like from a state guarantee fund perspective, and other kind of implications of the two markets do differ. And even more so what Emily said, right, of understand your policy, right, of understand how it functions, what it means, because they do have that additional flexibility, which means it may not be as standard as what you would expect, or those kind of consumer protections that are embedded in a lot of the admitted market products. So I think there's certainly a role. I think it can supplement kind of that FAIR Plan. You don't, as I think was alluded to earlier, the FAIR Plan growing is usually not the goal for folks, right? Because you have that massive concentration of risk, right? Of all these kind of high risk homes in a specific geographic area, that's going to naturally increase the cost of providing that coverage. So having it be in a private market, whether that's admitted or non-admitted, can be preferable for a variety of reasons. But yeah, I'm curious to hear the other panelists' thoughts as well.
I agree with you that I think they have a role to play. I do worry about if they're starting to take over as like the primary form of insurance that people get. Part of the reason is that admitted insurers have more incentive to work with the regulator, to work with the communities, because they are in the state's market for the long term. Whereas, surplus lines, it is a little uncertain. And I also agree with you that, it's important that consumers are educated on what is the key difference in that protection, because this can become a form of underinsurance as well, potentially.
Last word, Emily?
Yeah, I think you both hit some really important points. I think that it can be scary if they are not then part of the FAIR Plan. So they're taking people out, but they're not helping secure that we have a healthy FAIR Plan. We do have to have some insurer of last resort just for the housing market in general. You saw how many people had to choose the FAIR Plan in order to close on their home. They do have carve-outs. I worry about both the financial strength that the average consumer might not know to check the financial strength of a company they've never heard of. And then also, do they have a claim history? Have they ever had to deal with losses? Your name brand and admitted insurers, they have the capacity to to go through the claims process. And they do have that backstop of the California Insurance Guarantee Act Association to to have that be their backstop. So, ideally we would have a very healthy admitted market. And I think that is the goal that we want to get back to.
Thank you. Well, we're a minute over time. So thanks to everyone, all of the attendees to the webinar. Thank you to our panelists and especially to Nam Nguyen for the incredible work on the paper. Um, we will be back with more insurance related research in the coming months, and we're excited to continue the conversation with all of you. Thanks for attending today and have a lovely afternoon.